Okay, let's just dive right into this explainer. I want you to imagine something for a second. What would actually happen if every single business in the world decided to just invent its own entirely unique form of financial math? Like, what if a company in London measures its success by one set of completely arbitrary rules, while a business in Tokyo uses a totally different, contradictory system to track its cash?
Well, if there's no universal set of rules, reading financial data would become an absolute nightmare. We're talking about a chaotic financial Tower of Babel. Without a standardized system, you couldn't compare a brand new tech startup to a local bakery, let alone try to compare two massive multinational corporations. The financial data would be completely incomprehensible to anyone outside that specific company's walls. Regulators, banks, investors, and honestly, even the internal management would be flying blind.
And this brings us to a really crucial realization. As the quote goes, if each business makes the financial statement in their method, financial data becomes incomparable. We absolutely need a standardized language. We need a way for anyone, from a tax authority to a potential investor or a CPS student, to look at a company's health and instantly understand what they're seeing without needing some kind of secret decoder ring. And that shared language, that's what we call accounting principles. All right, so here is our roadmap for understanding this ultimate financial translator. We'll start with the financial Tower of Babel, move into what accounting principles actually are, cover the core concepts and key principles, look at accounting conventions, and finally wrap up with the universal business language. First up, Section 2. What are accounting principles? Basically, the rules of the game.
The absolute core of this entire system is GAAP. That stands for Generally Accepted Accounting Principles. These are the initial guidelines, the common rules and regulations for recording financial transactions and putting together financial statements. Now, it's true that different regions might have their own specific flavors, like UK GAAP, US GAAP, IND AS, or IFRS, but at their core, the fundamentals and the main objectives remain exactly the same worldwide. They're accepted because they are objective, reliable, economical, and totally logical to anyone with basic financial training. They're what brings standardization to the global market.
Moving on to Section 3, Core Accounting Concepts. This is our foundation. So before we even record a single transaction, we have to establish some ground rules. These are basic assumptions about how we actually view the business itself, called accounting concepts. The first big one is the business entity concept. This implies a strict, unbreakable boundary between a business and its proprietor. You literally cannot mix personal finances with company finances. They have to be treated distinctly. For example, if an owner buys a personal car using company funds, that has to be recorded as a withdrawal, not a business expense. Keeping these entities separate is the only way to accurately track how the business is actually performing. Once you've separated the business from the owner, you run into the absolute bedrock of modern accounting, which is the dual aspect concept. This is the entire basis of double entry accounting. It states that for every single account credited, a matching account shall be debited. Every single transaction has two sides, a give and a take, which completes the recording process. So if you buy inventory with cash, your inventory goes up and your cash goes down. It's this perfect continuous balancing act that ensures no value simply vanishes into thin air. Total debits must always equal total credits. There are a few other core concepts that form our foundation too. Take the money measurement concept. This just means we only record dealings that can be expressed in monetary terms. If it can't be measured in money, it might go in the footnotes, but it doesn't hit the main books. Then we have the going concern concept, which predicts the business won't just vanish tomorrow. We assume they're going to keep operating and won't be forced to sell off assets at a steep discount. Moving along, there's the accounting year concept. This breaks the endless life of a business into specific, measurable periods, like a monthly, quarterly, or annual cycle. And finally, the realization concept. This means profit is only identified when it's truly earned. If someone pays you an advance fee today for a service you haven't done yet, you haven't realized that profit until you actually deliver the goods or services. Let's jump to Section 4, Key Accounting Principles. This is where the action happens. Let's see how that foundation builds into specific, actionable principles for recording our data. First up, we have the revenue recognition principle combined with the matching principle. Together, these form what we call the accrual basis of accounting. You don't just wait around for cash to change hands to record a transaction. You record revenue when it's earned, and you record expenses when they are experienced. And crucially, the matching principle mandates that all expenses must be matched and recorded with their particular revenues in the exact same time period. This paints a vastly more precise picture of a company's financial health than simply watching the bank account balance go up and down. Now, what about the assets a business owns? Here we rely on the historical cost principle. This requires companies to track capital assets at the original price expended for them. Let's say a company buys a warehouse for $1 million. 10 years later, maybe the real estate market booms and it's suddenly worth $3 million. Doesn't matter for the main balance sheet. It is recorded at that historical cost of $1 million minus standard depreciation. We don't adjust it for wild swings in market value because doing that would make the financial statements highly volatile and way too subjective. Which brings us directly to the objectivity principle. This principle demands that all financial statements, records, and information should be completely independent and free from biases. An accountant's job isn't to make the company look good or to try and influence end users into taking specific actions, like buying more stock. The goal is brutal, neutral honesty. The records must show the true financial position of the company. Nothing more, nothing less. Section 5. The accounting conventions. Think of these as the safeguards. So the crucial point here is that alongside those strict principles, we need agreed-upon habits or conventions to keep the whole system practical and honest. The cost-benefit principle and the materiality convention go hand in hand here. Look, accountants shouldn't spend $10 of labor trying to track down a missing $1 pen. If recording an insignificant event costs the company more money than the benefit of actually knowing the information, it just shouldn't be recorded in excruciating detail. Materiality states that all significant facts should be recorded and disclosed, but accountants have the flexibility to ignore completely insignificant data to keep the whole process efficient. Then we have a fantastic safeguard known as conservatism. When an accountant is faced with two different ways to record a transaction, conservatism dictates they choose the path that records the lower profit amount. They act with caution. By this convention, you never, ever want to overestimate profits. If there's a potential probable loss on the horizon, you prepare for it and record it as a provision immediately. But if there is a potential probable revenue, you don't record it until you are completely confident it will be received. It protects the business and the investors from nasty surprises down the road. And we absolutely cannot forget the consistency convention. This rule insists that a company must apply the same accounting principles and methods steadily from one period to the next. You can't just use one depreciation method this year to make profits look high and then switch to a completely different method next year. Consistency guarantees that anyone reading the financial statements can accurately compare the company's performance across different stages in its history. If you change the rules of the game halfway through, the score just doesn't mean anything anymore. Finally, Section 6, the universal business language, putting it all together. Wrapping up this explainer, let's look at how all these layers secure the reliability of financial reporting. It's really a stacked system. Step 1 relies on those base accounting concepts, like knowing the business is completely separate from the owner. Step 2 applies the key accounting principles, like accrual basis and historical cost, to actively record the data. Step 3 applies the agreed accounting conventions, like conservatism and consistency, as safeguards. Together, these three interconnected layers allow a business to communicate its true financial performance clearly and securely to stakeholders literally anywhere in the world. I want to leave you with one final thought, and it's rooted in the disclosure principle. This principle demands that all information, both advantageous and disadvantageous, that could significantly affect a user's decision must be disclosed in the financial statements, very often in the notes. This stops companies from hiding massive future risks from you. So the next time you're flipping through a glossy, overly positive annual report, don't just look at the big numbers. Ask yourself, based on the disclosure principle, what fascinating essential truths are they required to reveal deep down in the footnotes? Thanks for joining me on this explainer, and keep asking those great questions.